It doesn't come with more government. It comes with less government. Denied, denied, denied. This is at 0% interest rates. It's distorting the ability to create more goods and services, as instead of going long the 10-year, he actually went long with leverage on the 2-year. I never try to figure out price direction. Never, ever, ever. The information that he's getting, that he is not sharing with the general public, is not good. He risks re-acceleration inflation. He also risks being Arthur Burns. You hit the nail on the head. It's all about insider information.
Welcome back to another episode of the Meet Kevin Show. Today we have the honor of interviewing and confronting George Gammon. Thank you so much for being here. You know, George was there for me when I was in court in California trying to fight Governor Gavin Newsom, and you were behind the scenes in the green room ready to testify for me.
That's right.
Thank you for that.
No problem.
But now you have a big warning, and thank you. Something weird is happening right now in the economy, and you just went live on it. Catch us up. What's going on?
Well, it's all about something called the yield curve. Okay. So for your viewers, I'm sure they're probably somewhat familiar with this, but we look at the treasuries, and you've got the 1-month treasury, and that goes all the way out to a 30-year treasury. So this is what we would call the treasury curve. And what we have seen historically is when it inverts, so what that means is the long-term interest rates are actually lower than short-term interest rates, which is the opposite of what they should be, right? Because if I'm going to lend you $1,000 for 2 weeks, sure, I'm going to charge you a much lower interest rate.
I might even do it for free.
Right. Unless compare that to if I'm lending you that $1,000 for 30 years. Well, now all of a sudden I got a ton of risk. I've got inflation risk. I've got counterparty risk. And therefore, I'm going to charge you a much higher interest rate. So that's why you almost always see longer term interest rates much higher. Right? It's just like if you go to the bank and you have an adjustable rate mortgage, okay, that's going to be a lower interest rate than if you have a fixed rate mortgage over 30 years. It's the exact same concept, okay? So what happens is when the 10-year treasury yield goes lower than the 2-year treasury yield, let's say, this has always been a red flag. And what we've seen going back to 1950 is almost every single time that you get an inversion, it precedes a recession. Or in today's terms, a hard landing.
How did they pull that off in 19? We had the inversion in 19, but the bond market couldn't have predicted COVID. So would there just have been another recession?
No, I think it did.
Wow.
Yeah. So there's two ways of looking at that. Okay. But this is a great point because the question becomes, okay, if the inversion of the curve has been so accurate, how? Yeah. How has it been this accurate? Right. And so I think you hit the nail on the head. It's all about insider information.
Oh my gosh.
And so I just talked to Jeff Snyder about this, and it makes a lot of sense. And I think that we can use Kenny McElroy, who is just here, as a perfect example. So let's walk through this thought experiment, right? In 2019, the curve inverted in August.
Yeah, it was like the summer,
Right. Yeah. So if you look at now all the reports of when we likely got that leak out of
Wuhan,
the lab, if that's what happened.
Yeah, right.
You know, trying to keep it YouTube friendly here.
Come on, man, it was the bat, bro.
Right, but assuming that happened, reports now, and even reports that have come out by the politicians and the government, peg that to August of 2019. So let's just think this through, okay? And this is
I thought it was like December.
No,
people were getting sick then already in China. You're right.
Right, because they had those games, the military games. Or the military games was supposedly the first, super spreader event, if you want to call it that. So it would have had to come out prior to that, which you peg it right around August or so. So, and you know this well from your attempt in politics. There is that it's all about insiders, and they have access. Gavin Newsom, we talked about this earlier today. He has access to all the bankers in California.
Is that why FDIC bailed out Silicon Valley Bank?
Well, I think that, but we're getting to a very crucial point here. So let's think about this. An example of a financial insider would be a Stan Druckenmiller, a Warren Buffett, Paul Tudor Jones, something like that, right? So George Soros, another great example, right? So these guys have tons of connections, obviously all over the world, and specifically in China. So let's think about this. If it is true that this leaked from a lab, that scientist that knows what happened and know how bad that could be, he's going to get on the phone immediately with the local politician. Wow. right? That politician is going to call the next guy up. The next guy up is most likely going to know a lot of bankers. Those bankers are most likely going to know George Soros, or they're going to know Paul Tudor Jones. So what they're going to do is call Paul Tudor Jones and say, dude, you need to really pay attention to this. So what's he going to do? He's going to hire or pay for one of his research analysts to go out there to Wuhan specifically and talk to that scientist, right? So his research analyst or whoever works for him is going to go out there, talk to the scientist. Then when he talks to the scientist, he's going to get on the phone with Paul and say, dude, this is real. Like this could end the world.
Oh my gosh.
Okay, so then if you're Paul Tudor Jones, what do? You buy treasuries. You buy treasuries because you're going to buy the most safe and liquid asset available, which whether we like it or not, is the United States Treasury, more specifically the long end of the curve. So why would they buy the long end of the curve? Well, you know this, your viewers might not, but if interest rates go down by 1%, prices are going to go up by much more if you own a 30-year bond compared to a 1-month bond, right? So if you're out there looking for capital appreciation, or if you're just hedging your portfolio, you're going to get far more juice the further you go out the yield curve. So all the Paul Tudor Jones types start buying the long end, which makes interest rates come down lower than the Fed funds rate because they're expecting lower growth and inflation expectations. It goes back to Irving Fisher, right, in the 1920s and 1930s. And so that's what this is all about. And in my opinion, that's why the curve has such great predictive powers. It's because these they're just trading on insider information, right? And that's why it's always correct. So another example I use is just our good buddy Ken McElroy, or even you. You know, how many doors do you have right now?
Oh, we just started a real estate fund. I think we're now we're probably in total will be like 45, 50 doors or something like that.
Okay, fantastic. Yeah. So let's just fast forward here 10 years, and I'm sure you're going to be just as successful as Kenny McElroy. So right now, Kenny has 1.5 billion with a B under management. So let's just assume for a moment he has 100,000 apartment units. Sure. Okay. Well, if there's a guy that's going to have insider information as far as what rents are doing, it's going to be Kenny McElroy.
Of course.
Right. So let's just assume for a moment that there's an ETF where you can short rent rates at a national level. Okay. You can go short rent rates.
Right, yeah.
So if Kenny, with all of his 100,000 apartment units, sees rents going down.
Can't get the unit rented anymore, has to lower rents.
Occupancy going down. He sees all this in real time. He has this insider information that is legal, but it's still information that Wall Street doesn't have yet. Right. And definitely, they're just listening to these CNBC headlines where they're saying, oh, the economy's booming and rents are going up.
Right.
That's not what I'm seeing.
Super lag.
So I'm going to go out there and hedge the portfolio of multifamily properties that I have. And I'm going to do so by buying that ETF that goes up in value when rents go down. That's effectively the 10-year treasury yield. That's amazing. Right? That's the 10-year treasury. That's the equivalent of the ETF that you would buy to go long rents going down.
So,
right?
And what have you seen today?
So what we've seen today is the 2-year treasury yield plummet. And when I mean plummet, it's down maybe 10, 15 basis points. And I think at the lowest point today, it got down to about 4.1, which is massive because just 2 days ago it was about 4.35.
25 points.
So it's a 25 basis points drop in 2 days. Now, most people would see that and say, oh, I mean, that's percentage-wise, it's not that big of a deal. But they have to realize in the treasury market, that is huge. And so
this is abnormal, in other words, that movement.
Absolutely abnormal. And what makes it even more bizarre is that there's no news. You know, you had PPI come out today that I think was a little bit lower, but that would not.
And CPI yesterday a little hotter, so it's kind of like you'd
right. So it's like a wash.
Yeah, exactly.
Right,
wash on.
So it really wouldn't explain the 25 basis point drop. Now, what's happened because of that 25 basis point drop is it's gotten much closer to the 10-year treasury yield because all of us know that the curve has been inverted for the last, let's say 18 months or so, right? So now what's happening is we're seeing that uninversion of the yield curve where it's coming like this. So the 2-year is going down, 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 down. The 10-year is going down, but it's going down at a slower rate. So why is this important? Because historically, what we've seen going back to the 1950s is it is true that the inversion of the curve has preceded every single recession that we've had. But we don't usually have the recession when the curve is still inverted. We have the recession after the curve uninverts.
And we're about to.
So, well, we got a lot closer over the last 2 days, and it's looking like it's going to uninvert. I mean, who knows? Maybe in the next 2 weeks, the next month or so. And why that's important to retail investors is you realize that once that curve inverts. Now, what we also need to talk about is the bull steepener versus the bear steepener, which we were discussing earlier, because that would be a big signal that we're either confirming the action or it's disproving.
So I want to go into that.
Yeah.
If I can, I want to pick up on this too. Is it possible that the 10 is falling because people are convinced that rates are going to come down, so they want to lock in those rates longer, so they're buying the 10-year more than they're buying the 2? Or could there be a logical explanation outside of recession?
Well, let's think that through, because long-term interest rates are future growth and inflation expectations,
which seem to be low now.
Right. So let's just assume for a moment that the 10-year Treasury yield was coming down just simply because people thought that the Fed did a great job. And rates
Statues
are
of
going to come
Jerome
back
Powell.
down. Right, exactly. And that rates are coming back down, or excuse me, the CPI is coming back down to 2%,
Sure.
the Fed's target.
Mission accomplished.
Mission accomplished, that's right. And therefore, the Fed is going to drop rates down to, let's say, 3.5%. And we've got unemployment at 3.5%. And that's going to allow the economy to go ahead and boom further. We've got stock market at all-time highs. This is pretty much the narrative that you see. Right. Okay, well, in that scenario, it is true that inflation would come down, but what would happen to growth expectations?
Well, I guess longer term would probably stabilize lower.
Well, future growth expectations would increase.
Because you're dodging a recession, you mean?
That's right.
Sorry, I was thinking the dropping of the 10-year yield, that maybe we're not looking at the 5% GDP growth, for example, we had estimated last quarter.
But so there's two components there. There's two components. So what we've got to compartmentalize is the growth expectations and inflation expectations. Yes, so what you're talking about is inflation expectations going back down, right to 2%. Yep. And this is what is allowing the Fed to drop rates from 5.25%, let's say down to 4 or 3.5, something that would be far more accommodative.
The real tightness stays the same, so to speak, as those inflation expectations.
But those interest rates would be more accommodative, let's just say, for the real economy. Now, all of a sudden, people can get mortgages at a cheaper rate. People can borrow money for cars at a cheaper rate.
Buy now, pay later.
Yeah, they can do all these things, and it really releases a lot of the pressure in some of the commercial real estate and maybe some of the banking issues that we saw in 2023 and March and whatnot. So in that scenario, it is true that the Fed could drop rates if inflation is coming back down closer to their target. But what's also going to happen in that environment, theoretically, is growth expectations would also go up.
Right. Okay, I see what you're saying now. Yes, absolutely.
So it's not just one or the other, it's the combination of both.
Okay,
You see?
I see.
So if yields are going down, which is what we're seeing on the 10-year Treasury, and mind you, we talked about the 2-year tanking. Yes. Well, yields on the 10-year Treasury have gone down as well, just at a slower rate.
I see. Okay. So your argument, to streamline it for the viewers, would be, hey, what we're seeing right now is that the 10-year is dropping while the 2's dropping. But wait a minute, if we thought the economy was about to boom, then we would think the 10-year should be going up.
Boom.
Now, counter question would be, what if people think the economy is going to boom with next to zero inflation, just to go extreme for a moment on the argument? If people thought, well, we'll have, strong economy at maybe 2.5% growth or whatever, with inflation at 0 or 0.5% below the Fed's target, could you see both yields drop in that case?
Yeah, well, what you'd see there is you'd see a nice upward sloping yield curve.
You'd see a normalization.
Yeah.
Which we're kind of trending back towards now.
No, the 10-year's going down. Remember, the 10-year,
this both going down still, yeah.
Yeah, I mean, just a couple months ago, the 10-year Treasury was over 5%.
Yes.
And now it's at 3.9%.
Bill Ackman, did you see that play? Bill Ackman. He did the, what was it? He's been complaining that the 10-year was going to go above 5%. So what he did is he shorted treasuries heavily, and talked about it nonstop on social.
Yeah.
And so he's like, it's going to go well past 5% is what he said. As soon as it got to 4.9, wow, these are a deal. Covers, goes long the treasuries.
Oh, smart.
Well, I think he played it.
Yeah.
Yeah.
I think you're better off kind of listening to Druckenmiller than Ackman. But if you look at what Druckenmiller did, I think that was really genius as far as that trade. And what he did is instead of going long the 10-year, he actually went long with leverage on the 2-year.
Because he expected the 2 would fall so much faster, the yield, therefore the bond price up.
Not only that, but he also saw a little bit more risk at the long end because of the deficits and because of the supply side of the treasuries.
Yeah, that's a good point.
So that was really a kind of a genius, as you would expect from Druckenmiller.
Yeah, of course.
Yeah, but it goes back to if the market, the bond market, was expecting a no landing type scenario with what you're saying, the 10-year treasury yield would be going up as the Fed funds rate comes down.
Sure. So
therefore, you'd get to that uninversion by the front end, maybe coming down slightly, but the long end going up more so than the front end, which so then what you'd have is, let's just say the Fed funds right around 4.5%, right? And then which would be 75 basis point cut. Yeah. And that's what they're saying, three cuts right now. Sure. But then the 10-year treasury would not be going...
5 or whatever.
Yeah, the 10-year treasury would not be going down to 3.9%. It would be going from 5%.
Even higher.
It would be going higher.
Oh my gosh.
Higher, it would be going up to 6, maybe 6.5%. I see. If it was projecting even lower inflation, but yet much more growth.
That is interesting. So maybe a more normal curve might look like that. Okay, Fed funds, the 2-year aligns with that. You go 4.5. You go say 6.5 on the 10.
Yep.
So we've got a 2 spread here.
And then 30 would be higher.
Yeah, exactly. Even higher. Exactly.
Yep.
So you've got your normal yield curve. Now,
and if it was and now let's talk about if it was predicting a no landing.
Okay.
With a reacceleration in inflation. Okay. Then you would see it even steeper.
Even steeper of that curve.
That's right. Then the 10-year, it would be screaming higher. Sure. Because it's now you've
pricing
got the
in
growth.
Inflation.
You've got the growth expectations higher, and then you've got the inflation expectations
so
higher.
Is there a chance that we have this, like you mentioned, would be normal, let's say 4.5 to 6.5, let's say.
Yeah.
Is there a chance just to go extreme, pull both sides down 4%? And so you're 0.5% on the 2 and 2.5 on the 10-year. And that's what we're marching towards.
Right. So it's always possible. I like to remind people that there are no certainties.
That's fair.
In this world. They're only probabilities.
What would that mean?
Well,
deflation?
No. What you're talking about there is, first of all, the Fed funds rate is at 5.25%.
It'd have to go to 0.
Yeah, well, it would have to go down to, let's just say the 10-year goes from 3.9, because when the Fed is decreasing rates, I don't know that there has been a time in history where the 10-year has actually gone up, straight up as the Fed's dropping rates, because usually when the Fed is dropping rates, it's doing so to prevent a recession or crisis, right? They're always behind the curve.
Oh, for sure. I think if they miss here on jobs and we start having a self-fulfilling layoff cycle, we're deep in a recession.
Yeah, and remember that jobs is always a lagging indicator.
Super light. That's the problem. Once you have that, it's too late.
Yeah, if you actually look at the LEI, which is the leading economic index, and that was the conference board or something, I forgot the entity that puts that out. But you see that when it gets past -4, we've always been in a recession, not just predicting one, and now we're at -8. And then if you look at GDI compared to GDP, we see that, in fact, I did a video on this the other day, that the Fed, I went to their website and saw a report that they gave in 2016, where they themselves argued that the GDI was a far better predictor of economic growth or economic recession than the GDP itself. Wow. And right now you have GDI negative and you have GDP going up. There's a delta there, sure. Right? And the only time that we've seen that divergence with GDP and GDI was just prior to the GFC.
Wow, that's a pretty big crash. That's not even as they say, the shallow recession.
Yeah, but another thing I think your viewers might want to contemplate is, this whole Jerome Powell pivot thing. Yeah. Okay, I think we need to, and a lot of people assume that, hey, well, if interest rates are coming back down, Well, that's going to be fantastic. That's going to be great for the economy. That's going to be great for the stock market. But what they're forgetting to ask themselves is, why are rates coming down?
Well, Jerome Powell's argument would be that
Right.
inflation is falling.
Right. Exactly. But let's think that one through. Okay. So if you're Jerome Powell, you're 65, you're 70 years old, you're worth $100 million. The only thing that you really care about right now, or your number one priority, would be your legacy.
Yeah, reputation. Absolutely. Yeah.
Right. So you know that history is going to remember you one of two ways.
Aaron Burr or Paul Volcker.
You're either going to be
a hero or a loser.
That's right.
Yeah.
That's right.
Simple.
So you want to be Paul Volcker.
Yeah, exactly.
You do not want to be Arthur Burns.
Arthur Burns. Not I said Aaron. My bad.
No problem.
Yeah.
You don't want to be Arthur Burns.
Yeah.
Right. So let's think about the scenarios here. You've got no landing, you've got soft landing, and you've got hard landing. Well, what's interesting is if you look at the incentives involved here, Jerome Powell has every incentive for a hard landing.
What?
Because, well, if we have a hard landing, then history remembers him as Paul Volcker,
who solved inflation and comes and bails it out.
That solved inflation by creating a recession.
Right. Yeah, exactly.
He had the
but
ball.
That's terrible.
That's how history remembers Paul Volcker.
True.
He had the balls to do what
right.
no one else was willing to do,
Well,
and
that's
make
true.
the tough decisions to take rates high enough
Right.
to break the back of inflation, even though it created an economic recession. That's, now, right or wrong, that's how history remembers
Yeah, that's true.
Paul Volcker.
But it's also scary because it creates that hardship of joblessness and
It does, but let's just look at it through the lens of legacy.
Yeah.
And the
yeah.
incentives
That's
just
fair.
for
Okay.
one man that at the end of the day is a human being and is flawed just like any of us.
So you think he's incentivized to cause a recession but then we had such high inflation expectations, which we don't today.
But okay, now you're getting to the next point here.
Okay.
So that's the hard landing.
Okay.
Paul Volcker, if we just look at it through that lens, is remembered as a hero.
Yes.
Okay.
We can agree. Yes.
So soft landing, he's most likely also remembered as a hero. But where he's got risk is the no landing. Because the no landing, what he risks is a re-acceleration in inflation. And if he risks re-acceleration in inflation, he also risks being Arthur Burns.
Yes. Yes. Yes.
So let's just assume for a moment that that's his main driver.
Don't be Arthur.
Don't be Arthur Burns. So then you got to ask yourself, what would it take to pivot when inflation is still above your 2% target?
Right. On the annual basis. Yeah.
In my view, that means that the information that he's getting, that he is not sharing with the general public, is not good.
I agree. Because you're essentially arguing he's seeing that softness at small business contacts, that insider information. He's calling up the Warren Buffetts, the business owners, the owners of whatever, all the insider info. He's on the phone going, oh, we may have gone too far.
Yeah. And they've got the beige book. I don't know if you've done a video on that, but the most recent beige book, and if
that's their surveys and talking to people
with the regional, with the regional banks,
right?
That's their surveys. So it's all anecdotal, but that's the insider information that you're talking about. And if
I think
you
they
look
censor that too.
If you look at but did you look at the summaries? In
of
the last
course,
report
each
that I
area,
saw,
New York, Philadelphia, but
exactly.
of course,
If you looked at the most recent summaries, they're all, it's getting bad. It's getting bad. That's pretty much the summary from every single one of these regional banks. Is that unemployment? It's getting, or the employment
turning.
picture. All these things are turning. So when you combine that with the LEI, and I also think that Jerome Powell is looking at their markets, because we have to understand that this is a globally connected economy, and the probability that we have a recession in Europe, a recession in Japan, a recession in China, and we somehow avoid a recession, the probability of that is incredibly low.
Yes.
Because of how global the economy is right now. And I would argue how global the monetary system is.
Yes.
Right? Because we have to understand.
It's all coordinated.
The banks create liquidity, right? So if you have a problem in the global banking network that we call the Eurodollar system, and if that problem is created by China, well, that's still going to spill over into the United States economy. You say, well, George, why should we care about liquidity? Well, ask Silicon Valley Bank if they care about liquidity. You see?
Yeah, well, and Jerome Powell turned on the money printer for that pretty fast, huh?
Well, look at the BTFP. That's another great point,
Yeah,
right?
straight up,
the
what,
BTFP,
130, 40 billion now?
and it's going straight up. And they're saying that it's because of an arbitrage. But see,
is that the explanation they're giving?
Yeah. So what they're saying, because the interest rate on BTFP is some esoteric spread. I think it's the 1 year forward swap spread, something like that.
The cost on that, yeah. Okay.
And so it's that interest rate plus 10 basis points. That's what the Fed is charging for BTFP. But on IOR, which is what they pay on bank reserves, it's still 5.25%. So what's happened is when interest rates, the expectation for Fed funds goes down, now all of a sudden in November, there was this arbitrage opportunity because the BTFP rate went down to, let's say, 4.9%, but they could still get 5.25 at IOR. So why not just borrow from the Fed and just park the funds there and pocket the spread?
Well, it's a 1 year loan. And so, and the program expires soon too. So you may as well use it. Now the question is, and it's a question for you, are they just going to extend it? Because they're certainly not going to call it all due at that moment.
I agree.
Just have a banking crisis again. Jerome doesn't want that.
I absolutely agree.
Okay.
Well, if he was worried about inflation, that would be one way to tackle it.
Yeah, just collapse the banks.
Yeah.
Kind of crazy to think they have the power to do that, but
let's focus, because I want to focus on that just for a moment.
Yeah.
Because if you listen to the mainstream media, you'll hear that it's all about this arbitrage, which could be true. But the reason I'm skeptical there is because when Silicon Valley Bank and First Republic and Signature, and let's not forget about Credit Suisse, when they went bust back in March of 2023, they set up this BTFP, and the utilization went straight to about 60 billion with a B.
In about 2 weeks.
Yeah. And so then what you would expect, if you listen to the mainstream media, is that it went straight back down to zero, because obviously the problem was solved, right? The clever Fed came in and with all of their tools and whatnot, and magically just kind of papered over the problem. Yeah. So then what happened is November, the arbitrage opportunity. So the big question in my mind is, okay, what happened between April and November? Did the BTFP go down? No, to your point, it went straight up still. So you cannot explain the parabolic move in the BTFP lately just through the arbitrage when it was going up between April to November when there was no arbitrage opportunity.
In other words, probably some additional residual stress is occurring or starting to occur where banks that weren't part of the program, which honestly probably looks like a little bit like a black mark. Like if you're a bank and you're showing up at the BTFP window or whatever.
It's like the discount window.
Yeah, it's like, that's embarrassing.
Yeah, that's right.
Yeah.
There's a stigma to it.
Yeah.
And that stigma is not good moving forward when you need to do business with all these other banks and your liquidity needs will be provided by these banks. Obviously, when you look at the risk reward, it's not just about the arbitrage.
Of course. Yeah, no kidding. So that's really interesting. So, okay, well, in that case, there are now estimates that forget waiting on rate cuts. We're going to start getting them in March. And who says they have to be 25 bips? We could be 3 rate cuts, but they could be 50 each. What's your take of that point of view, that we're actually going to get larger, more rapid cuts quickly? And then that would obviously suggest more problems.
Yeah. Yeah, because what people don't understand is that most often lower interest rates means tighter money.
Yeah.
Not looser money.
Well, sure, because banks stop lending.
That's right.
Well, everybody thinks, I'm going to get rich again when there's a recession. In fact, like you have this like TikTok mentality where everybody is like begging for a depression, which I don't know. I want your opinion on it, but I think it's crazy because, we look at like the last depressions were, the early 1920s and the end of the 1920s, horrible economic times. Sure, we had the social awakening of the roaring 20s in the middle, but depressions are horrible for people, but prices come down. And I think that's what people are focusing on now. It's like, we want prices to come down again.
Yeah, you got to be careful what you wish for.
Yeah.
Right? Because we had interest rates come down during the GFC, and that didn't exactly stimulate demand.
Right, because you had no job.
And by the way, it's not like, credit was free flowing. I'll give you an example. I got into real estate investing in 2012. And I retired, and I just wanted to manage my own money. So I thought, okay, well, what's cheap right now? My favorite investor was Jim Rogers, still is. So one of Jim Rogers' rules is just buy low, sell high, which sounds easy, but it's actually kind of hard to.
It's extremely hard.
Implement, right?
Yeah.
So I looked around. I thought that real estate was cheap. So what I did is I basically took my life savings. And I started buying all these rental properties in the Midwest And I was buying these things literally for about 50 grand. And then my model is, and this is in good neighborhoods.
Which
This is
states?
not Kansas City.
Okay.
Yeah, on the
wow.
Missouri side of Kansas City, and
Wow.
Lee's Summit and Blue Springs and whatnot.
Would you still buy there today?
No, because I've been selling since 2018. Because that goes to my rule that I never try to figure out price direction.
Okay.
Never, ever, ever. Okay. I just start by asking myself, is it cheap or is it expensive? If it's cheap, I buy it. If it's expensive, I sell it. Even if I think prices are going to continue to go up, it doesn't matter. Because I'm not trying to time the bottom. I'm not trying to time the top. And we can get into what I bought in March of 2020. It's the exact same concept. I bought oil, but I thought, and this was maybe it was at 20, I thought it was going a lot lower. I thought it was going down to 10, maybe even 5. But I started buying around 20 because the rule is you buy when it's cheap.
It went negative for a period of time.
That's negative 38. That's right. And so, but then I started selling around 80, 85, even though I thought the prices were going to continue to go up.
Sure, it could go to 100, 120.
At that point, adjusted for inflation, historically speaking, it got to the point where it was expensive. But my point there is I bought all these properties, Kevin, cash. Yeah. Cash. So I had this portfolio of, let's say, 15 rental properties that I put renters in. I'm in it for maybe $75,000 a pop. I'm collecting $1,000, $1,100 a month in rent. I have no debt, none. It's all, well, with the exception of the expenses.
Property taxes and stuff. Yeah, but that's 30%, whatever.
All positive cash flow.
Yeah, exactly.
Right. So now it's maybe mid 2013 or something like that. I am the perfect borrower. The perfect borrower.
Oh, of course.
Right?
Extremely
I've got a
low
780 credit score, whatever it is. And so I go to the banks. I'm like, look, I've got all this equity. Can I at least get just maybe like a line of credit? I don't even know if I'll use it. No, just denied. I'm like, how about just like a 40% LTV?
Yeah, no.
Denied. This is at 0% interest rates. So this is an example of how interest rates can be very, very, money can be cheap, but it can also be extremely tight.
Of course.
And if money is tight, it's very difficult to have an expansion or a significant expansion in the overall economy. And so that's what you got to be careful what you wish for. If interest rates go back to 0, people think that it's going to be boom time, but they forget to ask the question, well, why are rates at 0?
Interesting. Well, because inflation's going to go away and we're going to fight deflation.
Right. But so then my argument
You don't believe that, do you?
Well, so here's my argument there. Okay. So people assume that 0% interest rates are normal. And they also assume that let's say Fed funds right now at 5.25%, they also assume that that's high interest rates.
Right.
No.
Just based on recent memory, sure.
No, what are you talking? No, this is normal. This is normal. So if inflation comes back down to 2%, right, and the economy is doing well, why would the Fed drop rates?
Has to be a problem.
Why would they wouldn't drop rates. They'd keep rates right about where they are because historically, this is about average. So if you've got a nice, a good, structurally sound economy that was growing at a nice clip, if you got unemployment at, let's say, 3.5%, if you've got all these things that are acting as tailwinds for the economy, and the economy is very, very healthy, running on all 8 cylinders.
Why cut?
Exactly. You would expect Fed funds to be right around 5 or 5.25%.
So what if they see 2% deflation and that's why they're cutting?
Okay, so then you have to ask yourself, if we have 2% not disinflation.
Right, correct.
But deflation. What does that mean for asset prices and what does that mean for the economy? Keep in mind, we have not seen 2% deflation since the Great Depression.
Right. This is true.
Right. Actually, I take that back. We saw it in 1949 because in the 1940s...
Going into the Korean War?
It was just prior to that. So what happened is we got out of the war, we had price controls. And then when they lifted the price controls in 47, the CPI went to 19%. And then it went just parabolic, straight up to 19%. And then 2 years later, it was actually negative.
Yeah, but like you go up 20% and down 2%. Like who cares?
Yeah, so prices are still a lot higher in aggregate total.
Yeah.
But we did have a period of not just disinflation, and that would imply that you have lower and lower rates of inflation, but we actually saw prices go down, and it was right around 3%. But if you go to 2009, right, people forget that we did have a quarter of actual deflation in 2009, but it was very, very quick. So I do not expect 2024 overall, even if we do have a hard landing, to result in massive deflation, because I think the central planners will come in and do more of what they did in 2020 or something like that, which takes us to the next wave of consumer price inflation. And that's why my good friend and business partner, Lynn Alden, she's been talking about this for a couple of years, that her base case is that the 2020s isn't necessarily the 1970s, but it looks a lot more like the 1940s. Where inflation is just this big roller coaster ride, depending on what fiscal policy looks like.
Oh, well, they're so good at balancing the budget right now. We should be. Oh, wait.
Yeah.
No, I mean, I think we went from stimulus checks in the 2020 year in 2021 to basically corporate stimulus checks now. It's all the Inflation Reduction Act, the CHIPS Act here will subsidize the factories. I mean, what do you think about that?
Yeah, I mean, the BTFP is basically a stimmy check for
banks. Yeah,
for
Gavin
banks.
Newsom's bank.
Yeah, but I think that people will probably see stimmy checks again.
Oh, really?
Yeah.
You think they'll go back to that?
Yeah. Yeah.
Like UBI or just straight?
Yeah.
Okay.
No, I think where this leads now, whether it's 2024 or in the next 5 years, I have no clue. Sure. But my base case, again, just probabilities here, is that we land in UBI territory. We land in price controls. Oh, wow. And we land in CBDC, because I think that's how they issue the UBI, because the Fed's balance sheet is infinite. Yes. And I think that they're going to try to control inflation through the extension of credit. Because if you're doing PPP and stimmy checks, let's say, you know that's going to create inflation if you don't offset it with a decline in bank lending.
Okay, another way to look at it. Yes, sure. That's interesting.
Right, because we're just looking at it through the lens of M2.
Yes,
so if M2 is going up
Yeah.
as a result of the Fed, we'll just call it, I don't like the term, but printing money, because they're giving stimmy checks, and it's basically on the Fed's balance sheet, the liability of the Fed. Then you see M2, more currency units chasing goods and services. This is inflationary. Right. The way that you combat that is say, okay, banks, you are going to start lending less.
Sure.
Right.
So you tighten the velocity, basically.
Yeah. So velocity. Yeah. Well, velocity would probably increase, but you'd have M2 money supply go up, because what you're doing in the stimmy checks is you're increasing velocity, because you're putting a lot more of the M2 money supply into checking accounts, which are a lot more likely for people to go out there and spend
than investments. Investments have a velocity of like 2, whereas money in your savings is like 4 or 5.
Yeah.
Or more.
The way, and I know that gets a little complex for the viewer, but the easiest way to look at this is, let's just say that the Treasury deficit spends by not doing, the Fed's balance sheet or something like that, but printing money. But let's just say they do that by borrowing money. Sure. Okay. So you're an investor. You want to buy a 10-year Treasury, something like that. So you've got an excess of your productivity. You've got savings, right? Well, that savings, you're not using that to buy Big Macs or buy your kids' diapers or anything like that, right? That's your savings. Yeah. So by definition, it's very low velocity. Yep. So you say, look, I'm getting 2% on my savings. Why would I not want to get 5.5% in a 3-month Treasury and just roll it over? So I'm going to go ahead and take this money from my savings, and I'm going to lend it to Janet Yellen, right? I'm going to lend it. That's buying a Treasury.
Exactly.
Okay. So then Janet Yellen takes that money and says, okay, well, what we're going to do is we're going to spend this on stimulus checks. So what has happened is that, let's just say $1,000 has gone from your savings account with 0 velocity, and it's ended up in someone's checking account with very high velocity. So that's how you can get an increase of consumer price inflation.
I see that.
Even though you're not doing, even though you're not quote unquote money printing.
Yeah, that's fair. I guess if you tighten lending, though, there's going to be a limit to how often probably that same dollar can roll over, because you can't leverage it, supposedly. But I see what you're saying. Like it should go up. So then the question is it, so really this all starts with the 2-year. The 2 years plummeting, and there are really, I see 2 choices. One is something's really wrong, which probably things have started to turn. I agree with that. The second is it's a combination where things have started to turn, and maybe through whatever lens the Fed is looking at it, they see inflation as solved. Is that a possibility in your opinion?
It is definitely a possibility. But again, we look at it through the lens of Arthur Burns and Paul Volcker. So even if the Fed thinks that inflation is solved, why would they drop rates? If the economy was healthy, and they're in their view, they're looking out into the future and saying, well, this is fantastic. Look at this trend. We've gone from 9% CPI all the way down to 3%. And, PPI today comes in a little bit low. So we can assume that it's going to continue down to 2%. But the economy is running on all 8 cylinders. In that environment, there is no need to drop rates. Why would you drop rates? The only reason you drop rates is because the economy is not healthy.
I agree.
Now, if interest rates were at 15%, then I think you got a great argument. Sure. Because interest rates are high. But 5.25%, that's not high interest rates. Those are normal interest rates.
So do you believe that a stronger economy will definitely induce inflation when they cut rates again?
So our hypothetical is that they cut rates and we have a strong economy. Mm-hmm. Yeah.
Why?
Why would it produce consumer price inflation? Well, the main reason that's going to produce consumer price inflation is, or at least inflation would reaccelerate, right? Is because what's happening there is you've got the banks now saying, this is fantastic. Yeah. Okay. We were worried about this whole disinflation. We were worried about recession. Now we have this bailout. This is great news. So we're going to start lending again. And we're going to start lending into the economy. We're going to start lending into the financial economy. And then what you would expect is something like the 1970s, where the M2 money supply goes up and up and up because future growth and inflation expectations are going up and up and up. Now, if that was the case, again, the 10-year Treasury yield would be getting ahead of that.
It should be showing that now.
It should be showing that now.
Right, by going up.
That's absolutely right. So I think, again, that's a possibility.
Yeah.
Right? That we somehow have this magic, like Cinderella story where growth...
Immaculate disinflation, yes.
Where growth just starts to boom, and then inflation at the same time does come down. Right. Let's just say that was all supply side stuff. Yeah. But then again, that the Fed would not drop rates in that environment because he's risking Arthur Burns and a reacceleration of inflation. It's a risk. It doesn't mean that it would happen or it would pan out, but you're risking that.
So is there this weird possibility that I always try to think about the business and like the individual participants in the economy. There were a lot of businesses that were really frustrated during COVID that they had all of this demand that they couldn't fill because the supply chains are too tight, but they were set for a normal, 2018 economy, not a 2021 economy. So then over the 22, 3, 4 period, we see this massive expansion essentially of manufacturing capabilities with substantially lower demand. Doesn't that mean we have this potential empty ballast almost to where you could substantially increase demand for supply chains that are now substantially stronger and more stable, hopefully, potentially, so that you can actually have real GDP growth without inflation?
Well, first of all, I think if they solve the supply side issue, that CPI wouldn't be at 3%.
I see.
I think it'd already be quite a bit lower.
So it'd be falling a lot faster, you think?
Yeah, because we have more goods and services.
Okay.
Right? Let's remember that deflation can be a bad thing, but it can also be a great thing.
Well, sure.
In a free market...
Well, everything should deflate.
That's right.
That's
absolutely right.
But I don't think they want that because that makes their debt more expensive to pay off.
Yeah, it makes their debt more expensive. I don't know. That's a whole separate topic. I don't know if we're at a point right now, even though the debt's at $34 trillion. I don't, believe it or not, I don't know that the debt in and of itself is a problem for the government right now. Why? Because there's plenty of demand for treasuries. If there wasn't a lot of demand for the treasuries, the 10-year wouldn't be at 3.9.
Right. Yes.
The 2-year wouldn't be collapsing in yield. In other words, skyrocketing in price.
Yes, that's a good point.
So there's obviously a ton of demand. And it's not like the bond market doesn't know that we're running these wartime deficits. Yeah. It's not like the bond market doesn't know about all the off-balance sheet liabilities.
It's not a meme stock, you're saying?
No. Paul Tudor Jones, George Soros, they get it.
Yeah, exactly.
The financial insiders, they get it, and they're still buying the long end of
So
the curve.
you're saying they're not worried about the debt, so we don't need to worry about this like imminent debt collapse. It's bad, but we don't have to worry about it today.
Yeah. So what people need to realize is what's bad about the debt isn't necessarily the debt; it's the government spending. See, the way the example I always use is it's like a heroin addict. Okay. So a heroin addict can have a credit card and run up the balance on the credit card to 100,000 buying heroin, which destroys their body, destroys their mind, and destroys their soul, right? So we could come into that heroin addict and say, guess what? We're going to take your balance all the way down to zero, so you no longer have any debt.
I just spend it again.
So is that a problem solved?
Yeah.
Or is that an even bigger problem? Because now he's going to go and do more of the same, what ruined him to begin with. You see, that's exactly like government spending. It's not necessarily the debt that's bad. It's the government spending which distorts the overall economy. Let me give you another statistic here that I think you'll find interesting. In the late 1880s, we were on a gold standard. Okay, so let's take a 15-year time frame from 1880 to 1895. Okay. We had about 30, right off the top of my head, 30 to 40% deflation. Deflation. Think about the benefit that accrues to the poor and middle class if we had prices going down by 40% over a 10 or 15 year period. Yeah. Even if their incomes aren't going up, their purchasing power is increasing massively. And by the way, during that time, nominal wages went up.
Sure.
Not down.
Well, at the low end. Yeah.
So if nominal wages are going up and prices are going down,
it's best case scenario.
Their purchasing power for the poor and middle class is just going absolutely through the roof.
Yeah, I agree with you.
So this is 1880 to 1895. Now let's fast forward, gold standard. Yeah. Let's fast forward to when the fiat standard went bananas, right? Peak fiat insanity from 2008
QE infinity
to 2020. QE infinity. QT, QE,
whatever.
Blah, blah, blah,
the
blah,
Qs,
blah,
yeah.
Right? The Fed's balance sheet to 8-9 trillion.
Right.
M2 money supply went up by 25% in 2020. Yada, stimmies,
but no inflation.
Yada. Well, no, we did have inflation.
Expansion of the money supply inflation, but not
no consumer
CPI.
Price inflation. If you look at compounded,
I guess nominal though,
If you look at compounded inflation, the CPI from 2008 to 2023, it went up by right around, let's say, 30 or 40%. So about the same.
In total. Yeah, yes, sure. So on an annual basis, it was like 1.8%.
Yeah, whatever. So let's say 2-3% compounded, you're going to get 30 or 40% after 15 years, right? Yeah. Or whatever the math is. Right. But let's rewind to the late 1800s, where you saw about the same amount of deflation. Right. Let's just say 30%, 30%. Now, what's fascinating about that is that the M2 money supply, the amount of currency units chasing goods and services, went up in the 1800s, that 15-year time frame, by 150%. Wow. Okay. But what will blow people's mind is that from 2008 to 2023 on this fiat standard run amok, it went up by 150%. The exact same.
That's very interesting.
The exact same. So then what you have to do is you have to ask yourself, okay, what was the catalyst? Why did one 15-year time frame
have deflation versus
inflation? Or said another way, why did one period benefit the poor and middle class and the other period hurt the poor and middle class?
Yes, I agree.
I've done a lot of research on this. Okay. And the one main variable that I can find is government spending as a percentage of GDP.
Oh, interesting.
So if we look at the 1800s, federal government spending was about 5% of GDP. Said another way, the overall output of the entire society came from the private, 95% of it came from the private sector, right? Where now it's 50-50. So who spends money more efficiently?
Oh,
is it the government or is it going to be the private sector?
Always the private sector.
Always the private sector. So is it any surprise that if the private sector represents 95% of the economy, we have more goods and services being created to the extent where prices are going down, even though the money supply is going up at the exact same rate?
See, that's very interesting.
You see, so the main takeaway here is what you have to do. If we want to create this society that's going to be more, let's say, friendly to the poor and middle class, it doesn't come with more government. It comes with less government, because that 50% of government spending to GDP, all that's doing, for the most part, is distorting the economy. It's distorting the ability to create more goods and services, which will drop prices, and that's that benefit that accrues disproportionately to the poor and middle class.
Right.
So that's why the debt in and of itself isn't really the big problem.
Yeah,
it's the government spending.
Okay, so is this a maybe depressing but potentially real scenario to think of? The government won't fix its spending problem. The debt won't lead our economy to collapse anytime in the near future. So instead, the money printer continues to circulate.
Yeah.
We see the wealth gap substantially widen, and if you don't have assets, you're getting left behind.
Yeah.
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 That's depressing.
I think you look at Japan. Yeah. Japan is kind of a playbook. So what's really interesting here is you say, okay, well, George, I get the reference to Japan. Japan's at what? 230% debt to GDP. Right now, the United States is about 110 or 120. And I understand that 34 trillion in debt is huge, but could we be the next Japan? Or what a lot of people would argue is the dollar going to turn into toilet paper and we're going to go the way of Argentina? So I think it's a very fascinating juxtaposition, because if you look at the two central banks and the two policies, not now, but back when the hyperinflation in Argentina was just getting started, they had very similar policies. So how is it that one economy produces deflation and the other produces hyperinflation?
Sure. Is it a loss
and
of
how
trust?
do you know if the U.S. is headed towards Argentina or Japan?
I know it's weird to think of like trust in fiat, but it's all relative. Is it because of a loss of trust in the institutions in Argentina versus maybe those of the Bank of Japan?
I think that has a lot to do with it.
Okay.
And then you have to ask yourself, well, why does that happen?
Well, right? Corruption or spending.
Yeah. And I think another thing I've been wrestling with quite a bit, and I haven't come to a definitive conclusion on this, but I think a large part of it could be the way the currency was created to begin with. So hear me out on this one. Your viewers may find this an interesting thought experiment. Let's say that I lend you $1, and I do so by just taking a dollar bill out of my pocket and giving it to you. And then the next day, you're like, you know what, George, I don't need this $1. I'm going to go ahead and pay you back. So you give me that $1, and we still have $1. We still have $1. So when I gave you that money or lent it to you, M2 money supply did not change. And when you paid it back, it didn't change. It's still 1. Now, let's think about this a different way. Let's say I'm your bank.
Oh, no.
Okay?
Fractional reserve bank.
And you say, okay, George, I want to borrow $1.
Yeah.
And I say, okay, Kevin, I lent you that $1. How did I do that? I didn't give you a green piece of paper. Yeah. I simply added a digit to your checking account.
Right. 0.
So now instead of having 0 in your checking account, you have $1.
Right.
What did we just do to M2 money supply?
Well, I mean, you just doubled it.
It increased.
Yeah, well,
it increased by $1,
and it's like 10x probably.
So then, what happens is the next day, going through this exact same example, you say, you know what, I don't want the $1 anymore. I'm going to pay you back. So then, when you pay me back, you don't give me a green piece of paper. I just simply change the balance on your bank account from $1 back down to 0 where it started. Yeah. So you see, what's happened is those two scenarios. I lent you $1. One scenario didn't do anything to M2 money supply. The other scenario increased M2 and then it decreased M2. So money was created and money was destroyed.
Yes.
Just by the process of lending and paying it back. So now let's think about it in terms of a pie chart. Let's say this pie chart represents 100% of the currency. So 100% of the yen in existence, or 100% of the Argentinian pesos in existence. And let's just take it to an extreme for the thought experiment and assume that 100% of the yen that exist were lent into existence. Now let's assume that 100% of the Argentinian pesos that exist were printed, literally printed into existence. Sure. So if demand goes down for those Argentinian pesos, there's still the same amount of pesos. Yeah. It's just you have the same amount of supply, demand goes down, so the value theoretically most likely goes down as well. But with the Japanese yen, if demand goes down for the yen, what happens? The debt is paid off. Therefore, the supply goes down with the amount of demand.
Interesting.
So as demand goes down, supply goes down as well, because you're assuming that if there's less demand for the yen, the people still have the yen debt. They're going to go ahead and pay off that debt, which decreases the amount of currency units. So you see how it's a complete night and day difference based on the pie chart and how much of the overall currency has been lent into existence compared to how much of the overall currency was printed into existence. If you look at Argentina, the majority of it, especially lately, was them literally just printing pieces of paper to send out, where with Japan, the majority of it, I would argue, was lent into existence by the banking system itself. So that's not yet conclusive. It's just something I've been thinking about. I've started to research it, and it seems that I could be on to something there. But that may explain the difference between Japan and Argentina. And if it does, then you have to look at the pie chart for the United States and the US dollar, which would be even more extreme than Japan.
But it's an argument against stimulus checks and for bank lending, theoretically.
Well, stimulus checks, so where are they coming from, right? They could be coming from just issuing debt that's taking savings and turning it into checking, right? If we were giving stimmy checks by what we did in 1862, and so I go back to that because that was the beginning of the Civil War. We had the Legal Tender Act. And that was the last time, as far as I can tell, that the United States government actually printed green pieces of paper to pay for bombs or bullets or whatever they were paying for, right? Now the process is the government would just go ahead and they would issue the debt. And if there was no one there to buy the debt, then the Federal Reserve would come in like they did during World War II.
Sure.
And then they would go ahead and buy
Lender
that.
of last resort.
So then the base money would go up,
Yeah.
but then you're assuming broad money goes up as well, which may or may not be true depending on who the Fed is buying those treasuries from. That gets a little bit complex. But the bottom line is they in World War II, they weren't literally printing green pieces of paper to buy bombs like they were in 1862.
It's all digital now on a spreadsheet, and the Fed just absorbs it all, basically.
And that can make all the difference in the world. That can make all the difference in the world.
That little thing you think could be the difference between Japan and Argentina.
Yeah.
That's very interesting.
Yeah.
Wow. That's so okay. Then brief outlooks. Just what do you do? What does somebody do? Listen, who's listening right now? You buy real estate, you wait for the real estate crash. Do you buy stocks at all-time highs, or do you wait? What do you do?
Yeah, so my favorite investor of all time is Jim Rogers. And one of the reasons he's my favorite is because he has a knack for just putting things in the most simple terms possible, which at the beginning, when you first hear it, it sounds oversimplified. Yeah. But when you think about it, it's actually very profound. The very first interview that I heard with Jim Rogers, it was in I believe the original Market Wizards books with Jack Schwager, which I'm sure you've read many, many times. And he was talking to Jim about his investment philosophy and how he's been so successful. He says, all I do is just sit in my chair and do nothing. And the guy says, okay, well, how does that work? He says, what the retail investor does is they're always trying to do stuff. Yeah. They don't have enough patience. So what I do is I just sit in my chair, I do nothing, and I wait for a big pile of money sitting in the corner. And when I see it, I go pick it up. And then I go back to my chair, and I just wait for the next pile of money to appear in the corner, and I'll go pick that up as well. And in the interim, I don't do anything.
Okay.
And I think that's a great philosophy for people right now. And the good news, Kevin, is that we're in this time when the curve is inverted. So to time this and to know what to do, it's actually pretty easy. Okay. If your base case, after listening to me and looking at the yield curve, is that this time is not different, and it'll likely play out like it has pretty much every single time since the 1950s. All you have to do as a retail investor is sit back, wait, do nothing. Personally, I'm just in gold and T-bills.
Okay. Wow.
Just a T-bill and chill type
That's
thing.
a little different from the 80-10-10 though, eh?
Yeah, so I'm waiting to increase and add to that 80-10-10 by buying
You're waiting
stuff.
to strike.
That's
so
right.
You're 100% essentially liquid, because both gold and T-bills are essentially liquid.
Yep.
To make your investments, to go pick up the pile.
Yeah, with my cash position.
Yeah.
You've got the main positions that you built, but with that cash position, you're building up a lot of dry powder. You're getting paid 5.5% on that. Yeah. And then what happens is I'm looking at the yield curve, and it's not complex. All your viewers need to do is watch two numbers, the yield on the 2-year treasury and the yield on the 10-year treasury.
And subtract.
That's it. That's it.
Yeah.
And all you have to do is just wait for that 2-year treasury yield to go down lower than the 10-year treasury. Now, is it going to immediately hit the fan? No, of course not. There's some timing there. But once you see that kind of, it might just dip and then go back down. But once it stays there for, let's say, a month or two, you know that that's the trend. At that point in time, you have to realize that that's usually when you have the hard landing. That's usually
within a month.
No, not within a month. It could be 3 months, 6 months, something like that. But
so
we're
some
getting
period
real
of
close
time.
To when the Fed will have to start. And I said have to start dropping rates. Right. I didn't say choose to start dropping. That's a big difference. I think the Fed is going to have to drop rates. They're not going to choose to drop them. And then what you do is you sit back, you ask yourself, okay, why is the Fed dropping rates? Or why are we having this hard landing? Is it because of a war? Is it because unemployment's going up? Is it because of the Middle East? Is it, why is it here? Why is this happening? And then you make a decision, you analyze, and you make a decision on what is cheap and what is expensive. And that's the pile of money that's just sitting in the corner. So right now, it seems like all this stuff is happening and it's so complex. But in my view, this is the easiest time to be an investor, because all you have to do is just sit back, build your cash position, have the dry powder, be liquid, be patient, watch the yield curve, and then assess once it's no longer inverted, and then take action.
Wow. That's really interesting. Yeah, I agree with you. That's very interesting.
But what's interesting, Kevin, is I spend, I'm very fortunate that I've got a lot of good friends of mine that are in a place called St. Bart's. Okay. And most of these guys were very, very successful hedge fund managers, and they've quite literally made billions of dollars for themselves and their clients. And in going there, I've just gained a wealth of knowledge. And the last time that I was there, I had a conversation with one of my good buddies that was just crushed it in Japan and the .com bust and the GFC. I mean, he is one of the most famous hedge fund managers. I'm not going to say his name, but he's one of the most famous hedge fund managers that we've had in the last 40 years, right? And so when he speaks, obviously I'm listening. And we went through all of these trades that he's made where he's made all this money. And he said, you know what? Every 10 years or so, you get a generational opportunity. And then every 2 or maybe 3 years, you get a good opportunity. And then in between those, you're kind of doing nothing. He says, but what I found is that with those generational opportunities that I have had, whether it's Japan, whether it's .com, whether it's GFC, whether it's 2020, those have always been the best investments of my life as far as return. But those have always been the hardest to buy. Those have always been the hardest to pull the trigger. And so I'll give you, and you can relate to this because we were both doing YouTube during the pandemic. And, prior to that, this is my mantra: buy things when they're cheap, sell them when they're expensive. Buy them when they're cheap, sell them when they're expensive. Buy them when they're cheap, sell them when they're expensive. And I'm sitting there doing YouTube videos on this daily, right? But then when oil actually gets cheap, was it easy to pull the trigger? Absolutely not, because everyone thought the world was coming to an end. Everybody thought the world was coming to an end. So you can sit there now, hindsight being 2020, and say, yeah, look at me, I was a genius because I actually bought. But I can tell you, being just as honest as I possibly can be, I did buy, but it was one of the toughest things that I have ever done in my life, Kevin. We can sit here and say how easy it is to buy low, sell high. The problem is that when things get cheap, there's usually panic.
Yep.
Panic. And to have the mental discipline to pull the trigger is what's most difficult.
Wow, that's really interesting. Wow. Yeah, I mean, I think the only way, because I agree with what you're saying, I think the only way the Fed can weasel their ways out of this is if immaculate disinflation and it doesn't come back up. I think that's the only thing that could explain this other than that.
And
otherwise, I think you're right.
And just let me remind you, if that happens, this time it's different. And as we all know, those are the most dangerous words in investing.
Yeah. Wow. Okay. Well, very well. So, how can people find you?
Oh, they can just look at George Gammon. I've got the whiteboard videos on the George Gammon channel.
They're so good, by the way. People love your whiteboard videos.
Thank you. Or they can go check out the Rebel Capitalist channel.
Sally on there.
Which is Moody the Millennial.
Oh, Moody the Millennial now.
That's right.
Okay.
Moody the Millennial, your friend and family member Fred. I try to make all this boring esoteric stuff fun.
Yeah.
But you can just Google my name and you're going to find the Twitter. You're going to find everything.
George Gammon, thank you so much.
Hey, thanks for having me.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is neither personalized financial nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF and hold long positions in various securities mentioned, including potential short positions. However, I have no relationship to any issuers, nor am I presently acting as a market maker.